Hey everyone, and welcome back to the channel. Uber just dropped its Q3 2025 earnings, and the numbers are a classic case of a beat and a paradox. The company smashed Wall Street's expectations across the board, and yet the stock took a nosedive in pre-market trading. So what exactly happened? Were the results not good enough, or is the market missing the bigger picture? In this video, we're diving deep into Uber's blockbuster report, breaking down the stunning profits, the hidden concerns, and what management is saying about the future. Let's unpack it all. Uber Technologies, ticker UBER, is a global mobility and logistics platform that operates primarily through a massive digital network connecting consumers with drivers and delivery partners via its user-friendly mobile application. Its core service, ride-hailing, allows users to book rides on demand, supplementing this with other offerings like Uber Eats for food delivery and Uber Freight for shipping. The company's innovative business model leverages a vast, asset-light ecosystem of independent contractors rather than employing drivers directly, which allows for significant scalability and flexibility. By fundamentally disrupting traditional transportation and delivery industries, Uber has established itself as a leader in the gig economy, generating revenue by collecting fees from each transaction completed through its platform. First, let's talk about the sheer strength of this earnings beat. Uber didn't just meet expectations, it blew them out of the water. Revenue hit $13.47 billion, up a solid 20% year-over-year, and beating estimates. But the real stunner was the earnings per share. Analysts were looking for 69 cents, but Uber delivered a massive $1.20 per share, a 74% surprise. This profitability was fueled by incredible user growth. The company facilitated 3.5 billion trips. That's a 22% jump, and their fastest growth rate since 2023. Monthly active consumers now stand at 189 million, up 17%. Simply put, the core ride-sharing and delivery engine is firing on all cylinders.
Now, let's look under the hood at profitability. This is where the story gets even more impressive. Adjusted EBITDA grew 33% to $2.3 billion, showing that Uber is not just growing, but growing more efficiently. The company is generating cash like never before. Operating cash flow is $2.3 billion, with free cash flow at $2.2 billion. This is a huge deal for a company that was once criticized for burning cash. Now, a quick note on that staggering $6.6 billion net income. A big chunk of that, about $4.9 billion, came from a one-time tax benefit. So while it's a great boost to the balance sheet, it's not repeatable from ongoing operations. The core operating income growth of 5% to $1.1 billion is a more stable indicator. The delivery segment was a star performer, with revenue up 29%, while the freight business was relatively flat. So, with all these fantastic numbers, why did Uber's stock fall over 7%? This is the paradox that has many investors scratching their heads. The answer likely lies not in the past, but in the future. Despite the strong beat, investors may have been hoping for an even more optimistic outlook. While Uber's Q4 guidance for gross bookings and adjusted EBITDA is still strong, projecting 17% to 21% and 31% to 36% growth respectively, it seems it wasn't enough to satisfy the sky-high expectations priced into the stock. Sometimes a good report isn't great enough for a market that demands perfection. There could also be broader concerns about economic pressures or increased competition down the road. Looking ahead, Uber's leadership is clearly focused on the long game. CEO Dara Khosrowshahi highlighted the company's commitment to innovation, particularly in AI and autonomous technologies. This isn't just a buzzword, it's a core strategy to improve efficiency, routing, and ultimately the bottom line. CFO Prashanth Mahendra Raja emphasized the company's discipline on profit expansion and returning capital to shareholders, signaling a mature, financially responsible phase for Uber. Uber's Q3 '25 was undeniably strong. It showed robust growth in its core business, a significant leap in profitability, and incredible cash flow generation. The company is positioning itself not just as a ride-hailing app, but as a global logistics and technology platform. Let's look at the bull case, the reasons analysts are excited about Uber's future. The core of the bull argument rests on three pillars:
growth, profitability, and diversification. Robust growth. Uber's core businesses are firing on all cylinders. We're seeing strong revenue growth driven by increasing trip volumes and gross bookings in both ride-hailing and delivery. People are using Uber more than ever. Expanding profitability. After years of heavy investment, Uber is finally turning a corner on profitability. Its margins are improving significantly, and it's now generating strong cash flow. This is a huge deal because it allows them to improve their balance sheet and even fund things like share buybacks. Strategic diversification. Uber is no longer just a ride-hailing app. They're strategically expanding into high-margin areas like Uber Freight for logistics, advertising within their app, and the long-term game-changer, autonomous vehicles. This diversification opens up massive new revenue streams. Because of this, analyst sentiment is generally positive. Many have moderate buy ratings on the stock, with price targets suggesting a potential upside of 12 to 32% by the end of 2025. International expansion, especially in emerging markets, only adds to this growth story. However, and this is a big however, the bull case is only one side of the story. There are significant challenges that have some investors hitting the brakes. The main concerns can be summed up as valuation, competition, and regulation. Valuation concerns. Simply put, the stock isn't cheap. Its forward PE ratio is higher than the industry average. This means investors are already pricing in a lot of future growth, leaving little room for error. Any stumble could lead to a sharp correction. Competitive and regulatory pressures. The competition is fierce. Lyft and rides, DoorDash and delivery, they're all fighting for the same customers and drivers. More importantly, regulatory risk is a constant cloud over the company. Debates over gig worker classification could fundamentally impact their business model and costs. Execution risks. Recently, some investors were disappointed by conservative EBITDA guidance and comments that the path to profitability for their autonomous vehicle division is longer than hoped. This is a reminder that their ambitious bets are long-term and carry technological execution risk. Macro risks. Let's not forget the broader economy. In a downturn, consumer spending on rides and delivery is one of the first things to get cut. High debt levels also remain a concern for a company still solidifying its financial foundation.
You have a company with strong fundamental growth, a clear path to sustained profitability, and a smart diversification strategy that could pay off handsomely in the long run. But you must balance that against lofty valuations, intense competition, and a regulatory environment that is far from settled. The consensus from the analyst community is overwhelmingly positive. Here's the breakdown. Out of approximately 40 analysts covering the stock, the vast majority, around 30, have issued a buy rating. This includes a couple of strong buy recommendations. Another 8 analysts advise holding, but crucially, there are no sell ratings to be found. This leads to a firm consensus rating of moderate buy. But what about the price? Where do they see the stock going? The average 12-month price target sits between $105 and $111. From current levels, that implies a potential upside of 12% to 21%. Now, it's important to note that targets range from a conservative $78 all the way up to a bullish $140, but the majority cluster right in that $108 to $115 range, showing a strong agreement on its near-term value. Recent actions from firms like BTIG, UBS, Bernstein, and Guggenheim all reinforce this view, with many reiterating or upgrading to buy or outperform ratings. The consensus tilts decisively in favor of Uber, with a buy recommendation prevailing and a positive outlook on growth over the next year. Analysts believe Uber has more room to run. The narrative has shifted from a pure growth story to a story of profitable growth, and the street is rewarding it. What other stocks would you like us to do a deep dive on? Let us know in the comments below. Thanks for watching, and we'll see you in the next video.